Okay, so I think we can go through the question. We see what we are told. We are told that the following financial statements were extracted from the financial records of 𝗲𝗡 Limited, a public limited entity, as at 30th April 2022. So with the comparative for the year ended 30th April 2021. So one, we are given the statement of financial position as at 30th April 2022 and 2021. So we have the non-current asset, which include PPE, intangible asset, and then at the current asset, we have inventory, trade receivables, cash and cash equivalent. And then we have share capital and reserves, which include ordinary share capital, share premium, revaluation reserve, retained earnings, and then we have the total. And then we have the non-current liabilities, which include 10% loan notes, dated 2025. So by being dated 2025 means that this loan stock, they will be redeemed by the company. In other terms, they will be returned by the company in the year 2025. So, and then we have the government grant, we have the deferred tax, and then we have the current liabilities. Then we have trade payables, current tax, and then we have the government grant, we have the total equity and liabilities. And then from there, we have the statement of profit or loss and other comprehensive income for the year which ended 30th April 2022. We have revenue, cost of sales, gross profit. We have other operating incomes, which include the government grant. And then we have the other operating expenses, profit from operation, finance cost, profit before tax. And then we have the income tax expense. We have the profit for the year, other comprehensive income, which include the gain on property revaluation. Then from there, we have the additional information number 1 up to note number 5. And from that, what you're required to do is we prepare a statement of cash flows for 𝗲𝗡 Limited for the year which ended 30th April 2022 using an indirect method in accordance with IAS 7. So from that particular question, from that information, what we are required to do is we prepare a statement of cash flows. But before we do that, we need to go through the additional information. We see what we are told, and equally we see, are there a number of accounts do we need to prepare here? Are there a number of items we need to compute? So what you are told in additional information number 1 is that 𝗲𝗡 Limited acquired some new plant during the year which ended 30th April 2022 at a cost of 1.8 million from a finance company. And from a finance company, we are told an arrangement was made as at the date of acquisition for the liability of the plant to be settled by 𝗲𝗡 Limited by issuing at par value a 10% loan note dated 2025 to the finance company. So then you're told the value of the value by which the loan note exceeded the liability for the plant was received from the finance company. So basically what you're told in that particular point number 1 is that this company acquired a plant, or basically this company bought a plant. And that plant, we are told it was bought from what? From a finance company. So the agreement between our company here, which is called 𝗲𝗡 Limited, and this finance company is that 𝗲𝗡 Limited was to pay for this particular plant, not in cash, but it was to pay for that particular plant by issuing the 10% loan notes. And therefore, what we said is that once the company acquire an asset and basically pay for that asset by issuing the loan notes, essentially we say that this is a non-cash transaction. So the company acquired a plant, yes, but was there any amount which was paid for that? No, there was no cash which was involved here. 2, the company issued this particular 10% loan note to this finance company to pay for that plant. Was there any cash which was received in respect to the issue of those loan notes? No. But what we are told is that the loan notes now which were issued by the company were in excess of the value of the plant, because in our case we know that the plant which was acquired here had a value of 1.8 million. But if you go back to the balance sheet of this company, specifically where we have the non-current liabilities, you'll be able to see we have an item called 10% loan notes. And you're given the 10% loan notes at the start of the year and also at the end of the year. Remember, you said that once you're given a question for cash flow, always we are given statement of financial position for 2 years, the current financial year and the previous financial year. We said that the figures which are included in the statement of financial position for the previous financial year, these are opening balances. Whereas the figures here, these are closing what? Balances. So going back to the statement of financial position, specifically under the non-current liabilities, so what was the value of the 10% loan notes at the start of the year? The 10% loan notes at the start of the year, they had a value of 5250, and at the end of the year, the value increased to 8250. And therefore, in this case, we said that the 10% loan notes increased with an amount of how much? Increased with an amount of 3 million, or basically 3,000. So we said that this represents the 10% loan notes which were issued during the current financial year. And basically, as per the information we have in the additional information number 1, is that this particular 10% loan notes, which had a value of 3,000, all of them were issued to this finance company which sold the plant to the company. And these particular loan notes, which were issued to that finance company, part of them were used by the company in terms of paying what? The plant which was acquired. So we know that the plant acquired had a value of 1,800. That means that the excess loan notes now, which had a value of 1,200, this particular amount now here was received by the company, or was received from this finance company in form of cash, because these loan notes having a value of 1,800 were used in terms of paying what? The plant which was acquired. So therefore, we say in preparing our statement of cash flow, what we are going to consider as far as this transaction here is concerned is this amount of 1,200, which was received in cash from the finance company. So therefore, maybe we can have some few workings. Although remember, we had done some of these workings, but I think we can just reduce them again. So we have the 10% loan notes, which were issued. We know that they had a value of 3,000. So out of these loan notes had having a value of 1,800 were issued to pay the plant, and therefore we say that this is a non-cash item. Is a non-cash item. We are not going to take into account that amount of 1,800 in preparing our statement of cash flow. So in preparing our statement of cash flow, what we are going to consider is that particular amount of 1,200. Is that amount of 1,200. So let's move to the other point number 2. And in number 2, we are told that the company motor vehicle heritage fleet. These are fleet of motor vehicles, a number of motor vehicles. We are told a fleet with a cost of 2.63 million and accumulated depreciation of 1.165 was disposed of during the year for cash proceeds of 1.81, and then you're told the profit on disposal had been included in the other operating expenses. Remember what we said here is that anytime the company sell an asset, you have to prepare the disposal account to determine was that asset disposed at a gain or at a loss. So therefore, as far as that point is concerned, we need to prepare the account which is called disposal account, and this account is prepared to determine whether this asset was disposed at a gain or at a loss. We said when preparing this account, on that side we should have the net book value, and on the credit side we have what? We have the sales proceeds. So first of all, we know that these motor vehicles were sold at a value of 1810. That is the sales proceeds. What is the net book value? Remember, the net book value of an asset is equal to the cost minus the accumulated depreciation. So therefore, to get this, we take the cost, which is how much? Which is 2360 minus the accumulated depreciation of 1165. And this was giving us a net book value of what? What was the net book value there? Net book value how much? Net book value ni ngapi hapa? How much is the net book value? Yes, it was 14 or is 1465. So basically what we know is that, or that is now what you're told in that point, that this plant was disposed at a profit. Remember, he said that once we have balanced this account, a balancing figure on this side is a loss on disposal, a balancing figure on this side is a profit or a gain on disposal. So what was our gain here? Because we have a gain or a profit. The gain ilikuwa ngapi hapa? Watu wachangamke. Yes, Kennedy, I'm told it was 345. So therefore, as far as that note is concerned, when preparing our statement of cash flow, the number of items you're going to take into account: one, we are going to take into account this profit, which you're told is included as part of the operating expenses. And basically being included as part of the operating expenses, it means that that profit of 345 has already been added to the profit, which we have in our income statement. This profit on disposal is a non-cash item. So therefore, you're going to less it from our profit. Two, when computing the net cash flow from investing activities, we are going to take into account this amount which was received from the sale of the motor vehicles, from the sale of that fleet of motor vehicles. So the amount of 1810, because this is money received from the sale of the asset. So therefore, two items we are going to take into account as far as that point is concerned in preparing our statement of cash flow. Let's move to note number 3. In note number 3, we are told depreciation charged on PP during the year was 5.49 million and was included in the cost of sales. Equally, this depreciation is a non-cash item which was taken into account in arriving at the profit. So what we are going to do, we are going to add it back to our profit. Number 4, we are told intangible assets were amortized during the year and amortization charged to the profit or loss, or the amortization charged to the profit or loss amounted to 540. So the amortization basically is the value of the intangible asset which was written off. Remember, he said amortization, to amortize an asset, to amortize a liability, is to gradually write off an asset or liability. So therefore, if you're told there was amortization which was charged on intangible asset, it is the value of intangible asset which was written off during the current financial year, and this amortization is treated as an expense, but this amortization is equivalent to depreciation. It is a non-cash item. So therefore, as far as that amortization is concerned, still we are going to add it back to the profit because it's a non-cash item. But before we move to the other point there, so first of all, in our statement of financial position, specifically at the non-current asset, what was the value of intangible asset at the start of the year? The value of intangible asset at the start of the year was how much? Value of intangible asset at the start of the year, who can see that figure? The value for intangible asset at the start of the year, yes, I can see that figure from our statement of financial position is 6150. What about at the end of the year? It was what? It was 6750. And actually here you can see that the value for intangible asset has increased. So generally, amortization should reduce the value of intangible asset. But if you check on the value for the intangible asset here, the value has increased. So therefore, it means that other than that amortization, there was another transaction. And if you see the value of intangible asset increasing, it is only one item which can cause that increase in the value of intangible asset: acquisition. It means that this company may have acquired additional intangible what asset. How can we determine that? We can determine that by preparing an account called the intangible asset account. So let's prepare that account so that we determine the value for the intangible asset which were acquired, the value for the intangible assets which were acquired. So how do we prepare this account? Remember, this is an asset account, and therefore when preparing these accounts, the opening balance should be a debit balance because this is an asset. We said all assets, they have a debit balance. So we take into account the value for intangible asset at the start, 6150, so that we record it on the debit side because this is an asset, and then the closing balance and the balance carried down should be on the credit side down here, 6750. We also know that during the current financial year, there was impairment loss. Not impairment, rather, there was amortization. This one reduces the value of intangible asset. So the intangible asset which were there at the start, their value will reduce because of that amortization. Remember, I've said amortization is equivalent to depreciation. So therefore, the amortization should be credited in this account because it should reduce the value of the asset. So how much is the amortization from that point? The amortization from note number 4, we are told was an amount of 540. So basically what that means is that once we balance our account, we're going to have a balancing figure on this side, which represent now the acquisition. The acquisition are what? The acquisition are the intangible assets which were acquired during the current financial year. So what is the balancing figure there? Which should be on the debit side. The balancing figure, you just need to get the total of the credit, which automatically is more, you less the amount we have on the credit. So that will give us a balancing figure of what? I'm given a figure of 1140 by there. 1140, and this, yes, also I'm getting the same from Hilda. So automatically that represents the additional intangible asset which were acquired during the current financial year. And equally here, when preparing our statement of cash flow, we're also going to take into account two items as far as that note is concerned. One, amortization, which you have said is equivalent to depreciation. We add it back to the to the profit because it's an non-cash item. And two, we also take into account these intangible assets which were acquired. So this one, we are going to take them into account specifically when preparing or when computing the net cash flow from investing activities. We said any activity relating to acquisition and disposal of asset is an investing. So we're going to take into account that amount of 1140 specifically when computing our statement, when determining the net cash flow from operating activities. So I think we're through with that point number 4. Let's move to the last point, number 5. And number 5, we are told during the year which ended 30th of April 2022, Maram Limited made a bonus issue of ordinary shares of 1 share for every 10 shares held, utilizing the share premium. So this is something we came across in the topic for a published financial statement. We said, first of all, a bonus issue is the issue of additional shares to the existing shareholders of the company free of charge. Free of what? Of charge. We say that once the company make a bonus issue, the company uses either the share premium or the retained earnings to finance that bonus issue. And we say the effect of a bonus issue is that the ordinary share capital of the company will increase, whereas the reserve used by the company, be it the share premium, be it the retained earnings, will do what? We reduce. So therefore, can we determine the bonus issue here? The bonus issue. The bonus issue. So in our case, we are told the company made a bonus issue, and basically we are told the bonus issue which was made was for 1 share for every 4 shares. which were held. For every 4 shares which were held. So how many shares were held by the company? How many shares were held here by the shareholders of the company at the start of the year? That is what you need to determine at the start of the year. We're told for every 10 shares. For every 10 shares, 10. Yes, this should be 10, not 4. For every 10 shares, yes. So what we need to do is we go back to the balance sheet of the company or the statement of financial position of the company, and we determine how many shares were held at the start. At the start, not at the end. So the ordinary share capital of the company at the start was 6,000. Then at the end of the year, it was 75. So what we are interested with are the shares which were held at the start. At the start. So how do we determine the shares issued at the start? We take the ordinary share capital, which is 6,000, this one, and then to determine the shares issued, we divide that with the par value per share. The par value per share is given in our statement of financial position as 10, and basically it means that this company had issued how many shares? 600. In other terms, those are the shares which were held by the shareholders of this company. So what we need to do is to determine how many shares were issued during the bonus issue. So we cross multiply, then we divide 1 times 600 divided by 10. So this will give us 60 shares. But remember, all our figures here are in thousands of shillings. So automatically that should be 60,000. And we say that whenever the company is to make a bonus issue, then the shares are issued at their par value. At their par what? Value. So mean that the total amount received by the company from the bonus issue was how much? Was 600. Was 6 what? 100. So basically, what does that mean? What does that mean? It means that if you check on the share capital of the company here, at the start of the year, the ordinary share capital was 6,000. At the end of the year, the ordinary share capital of the company was 75. So basically, what that means is that the ordinary share capital of the company increased with how much? Increased with 1,500. Are we together? Increased with 1,500. So this increase in the ordinary share capital automatically is due to the shares which were issued during the current financial year. We know that during the current financial year 1, the company made a bonus issue. The bonus issue which was made was for 600. The shares which were issued free of charge had a value of 600. A value of 600. That's what we have computed there. So the difference now between, or basically the difference here, which is 900. Is it 900? Yes. So this 900 now, this represent, unless told otherwise, automatically this represent the additional shares which were issued by the company for cash. Because what you need to note is that a bonus issue, no money which is received by the company from a bonus issue. This is a non-cash transaction or a non-cash item. There is no money which is received by the company from the bonus what? Issue. And therefore, the other shares which were issued here, which had a value of 900, this one, they were issued for cash. So what does that mean? It means that when preparing now our statement of cash flow, we are not going to take into account the entire increase in the ordinary share capital, but we are only going to consider the shares which were issued by the company during the current financial year for cash. That is shares having a value of what? 900. Shares having a value of what? 900. But we're not going to consider now the what we had as a bonus issue, because no cash which was received as far as the bonus issue is what? Is concerned. Is what? Is concerned. Maybe we can have that working here. Working 5 in respect to issue of shares, issue of ordinary shares. And basically in this case, we have said that the ordinary share capital of the company increased with 1,500. So this increase is due to a bonus issue of 600. And basically you have said that this is a non-cash item. Is a non-cash item. When we're preparing our statement of cash flow, you're not going to take into account that those shares issued as bonus shares. So what you are going to consider are these shares here, which had a value of 900 and which were issued for cash, I hope that is clearly understood. I hope that is clearly understood. So let's now, I think, prepare our statement of cash flow, because I think we are through with the notes. Maybe the other notes, or sorry, the other workings which are required. So we are going automatically to do what? To prepare them as we prepare our statement of what? Of cash flows. But what we need to do is now we prepare our statement of cash flows. And we need to have, first of all, the title. The title includes the name of the company, which is 𝗲𝗏 Limited. And this is a statement of cash flows. Which is for the year which ended 30th of April 2022. You also have to remember that we are told to use which method? The indirect method. Indirect method. Yes, so what we start with here always is the cash flow, or basically we always start by determining the cash flow from operating activities. The cash flows from operating activities, we need to have two columns, and all our figures there are given in thousands of what? Of shillings. So we need to have those two columns like that. Yes, so let's now prepare a statement of cash flows. Remember here what we said at the indirect method, always start with the profit before tax. Sasa? Yes, so let's start with the profit before tax. So the profit before tax, so basically this is something we have or we are given in our income statement. So can you give me this figure here? How much is the profit before tax from our income statement? Our profit before tax from our income statement in Ngapi? Profit before tax is how much? So you get this from your income statement. From the income statement which you're given, say I'm given that figure by Kennedy is 8190, and the rest are getting the same 8190. Yes, profit before tax. Just start with that. Start with that figure there. But remember what we said is that the requirement of IAS 7 is that always there you should start with the profit before interest and tax. Profit before interest and tax. But we said always make sure you start with that profit, because in most of the questions, the examiner will not give you the profit before interest and tax. So you start with that profit before tax. And then once you come to make the adjustment here, the first adjustment always should be for what? For finance cost, or basically for interest. So what you need to do as your first adjustment is to adjust that profit there with interest. So first of all, you add back the interest there, because as per requirement of IAS 7, you should start with a PBIT, profit before interest and tax. So the first adjustment, make sure, is the interest or the finance cost. So from our income statement, in arriving at this profit, how much finance cost was deducted? The finance cost that is in the income statement. Can you see the finance cost in the income statement? Just above our profit before tax. Just above the profit before tax. Yes, that is a figure of 705. That should be your first adjustment. Sasa? Yes, first of all, add back that interest, such that by now, after doing that, you have the profit before interest and what? Tax. Interest and tax. And then from there, after doing that, we have a number of items to be adjusted to this profit. Remember, we said under the indirect method, we adjust that profit with the ordinary three category of items. 3 items. 1, any non-cash item added or deducted in arriving at that profit. 2, changes in working capital. And 3, a financing or investing activity item equally added or deducted in arriving at that one profit, something like investment income. So what do we have? Before we come to the workings here, always you need to basically go through the income statement, the income statement. So when you check, in arriving at this profit here, the profit before tax. So do we have any item on the face of the income statement, on the face of the income statement, which you can adjust to that profit, even before taking the items you have in the additional information? So from the face of the income statement, I think one of the items was automatically the finance cost. We have adjusted that in our profit. The other item we have other operating expenses that should not be adjusted, but equally below the gross profit, we have the government grant. Remember, I said this amount of government grant, or essentially I mentioned something to do with the government grant. We said government grant are essentially any form of financial assistance a company gets from the government, maybe to undertake a certain project which is meant to benefit the public. So what we said is that once the company receives a government grant or this form of financial assistance, the company may be undertaking a project which will take maybe the next 2 or 3 years. And therefore, he said once the company receives that government grant, the company debited in the bank account and then credited in an account called government grant. And then we said that government grant will then have to be amortized. If the company, for example, received 1 billion, the company expects to use that money for the next 5 years, then we said the company should amortize that government grant over the next 5 years. The amount amortized every financial year, we said, is accounted for by the company as an income. But this income does not represent the cash received. Sasa, yes. So therefore, that government grant which we have in that point there, not in that point, but rather in the income statement, is the government grant which was amortized. That government grant automatically is a non-cash what item. Sasa, yes. So therefore, what we do is that you come and you take into account now the government grant here, a government grant. And the reason why we take into account this is because this was accounted for as an income, but is a non-cash item. This is a government grant which was amortized. It does not represent the amount of money which was received. And how much is it? It is 750. It is 750. Take into account it is added in arriving at fund. What we need to do is basically to do what? To less it. Is to do what? To less it. And I think those are the 2 items which we have on the face of the income statement, which we need to adjust to that profit. And then from there we have basically a number of items which we have here that now what we need to take into account. So working 1, we don't have any item which will be adjusted in the profit. Working 2, we have this profit. The profit or the gain on disposal. Gain on disposal. How much is that? It's 345. And this 345 equally, in arriving at our profit there, it was added as an income. And because it's an non-cash item, what we need to do is we less it. We less it, we less it. Then from there we have from this account here, we have intangible assets. The intangible asset account, we have amortization. Amortization of intangible assets. Amortization of intangible assets, which is how much? Is 540. And this amortization we have said is a non-cash item. In arriving at our profit there, this amortization had been deducted. And because it's a non-cash item, what we need to do is we add it back. We add it what? We add it back. So we have that. So the bonus issue, does it affect our profit? No. And equally, this one will not affect our profit. But I think also from the additional information there, there is something you have not taken into account, specifically in note number 3. In note number 3, additional information number 3, we have depreciation. Depreciation on PPE, depreciation on property, plant, and equipment. This depreciation, in our case, we are told was how much? Was 5490. 5490. So this depreciation in arriving at our profit there, it was deducted, take into account is a non-cash item. What we do is that we add it back. We add it back. We add it back. we add it back. Do we have anything else? I think you're through with the note 1, note 2, note 3, note 4, note 5. Yes, so I think we have considered all that. So what is the question here? Someone is asking about, Bill is asking about the gain on property devaluation. No, the simple question you need to ask yourself there, the gain on property devaluation, that gain, is it part of this profit? Is that gain included in that profit? The gain, you have to recall what we said in the, when we were looking on how we prepare an income statement for publication purpose. We said gain on property devaluation, we said that that is OCI. You have to recall what is an OCI, other compressive income. We said these are other items of incomes which are not included, which are not supposed to be included in the profit for the year. So that gain, we know first of all is an non-cash item, but it is not included in our profit there. So you don't need to adjust it in your profit. So, but basically we're going to take into account that gain. Remember, there is an account we said which you need to prepare to determine the PP acquired. Like if you check on this question here, there is nowhere we are given the PP which were acquired. Definitely by the end of the day, we are going to determine, well, there are some PP which were acquired by preparing the PP account. But I think as far as our profit is concerned, those are the only items which we need to adjust now to our profit before considering changes in working capital. So can you get the net amount here? Get the net amount which refers to the net changes. The net changes in cash, not the net changes, but we refer to that as net cash flow, sorry. Net cash flow before changes in working capital. Net cash flow before changes in working capital. So you take your profit, you adjust it with all those items. So I'm given a figure here of 13,830. Someone to confirm whether that is correct. So that then we move and we consider changes in what? Changes in working what? Capital. We consider the changes in working capital. Changes in working capital. Yes, I'm given the same figure of 13,830. Yes, so basically those are the items which we adjust now in our profit. So let's move and we consider the changes in working capital. Remember here we changes working capital. We said you just need to remember this RIP, which we say is not rest in peace, but rather we said it is an acronym for receivables, inventory, and payables. Receivables, inventory, and payables. So what you do here, you consider those three items of working capital. You determine did they increase or reduce during the current financial year. And basically, once you come across any question for cash flow, always these are free marks, because this part here, we do it in the same way in all questions. In all questions, you just to take the receivables, inventory, and payables at the start, you compare that with the closing balances. You just determine, was there increase or decrease? And then from there, you determine whether that increase or decrease is an inflow or outflow. So let's go to where we have current assets. Current asset in our statement of financial position. So from our current asset, we start with the first item of working capital, which is inventory. Can you tell me whether inventory increased or reduced? The inventory at the start, I hope you can see that figure was 11,445. At the end of the day, it was 13,300. So do we have an increase or decrease? Yes. So in our case, we have an increase. You come here and you say that we have increase in inventories. Increase in the inventories. So how much is the increase in our inventories here? From 11,445 to 11,300 to 13,300. Yes, so we have an increase of 1855. Now, Generally, we say the rule here is that any increase in an item of current asset, this you have to get it clearly, any increase in an item of current asset is a cash outflow. Any increase in an item of current asset is a cash outflow. A decrease in an item of current asset is a cash what? Inflow. And the reverse is true for current liabilities. So mean that any increase in an item of current liability is a cash inflow, and then a decrease in an item of current liability is a cash what? Outflow. For instance, we know that the reason why inventory increases, if you have a small car business, the reason why your inventory will increase is because automatically you have bought more inventory, bought more stock. So once you buy more stock, it automatically means that you pay the suppliers for that what additional inventory you have bought in your business. So that is a cash outflow. An increase in item of current asset, cash outflow, decrease inflow. So then can we go to the other item of working capital? We have considered inventory. We then consider receivables. So the receivables, still we also have an increase in receivables. So the receivables increased with how much? From 780 to 9230. An increase in receivables. Increase in receivables, Ningapi. How much is the increase in the receivables? Yes, I'm given a figure of how much. I'm given here a figure of 2150, which is still a cash what? A cash outflow. So then from there, we then proceed and we consider receivables. It is also important for me to mention here that when taking into account receivables here, there are some questions whereby you may be given trade receivables, other receivables. You consider both of them here, provided it is a receivable. Whether it is a trade receivable or other receivable, you consider that here separately. Because I've said, kuna maswali utapewa, you are given trade receivables, you need to determine was there increase or decrease of that, consider that here. And also you do the same for other receivables. Other receivables, in other questions, these are known as prepayments. So kama umepewa swali and you're given prepayments, that is, these are part of other receivables. You also consider them here. Kama umepewa prepayment under current assets, you also consider that here because it is part of other receivables. I hope that is clear. So then let's go to where we have current liabilities. We consider payables. And equally for payables, we do the same. There are some cases whereby you may be given trade payables and other payables. Other payables in other terms. Other payables, I've said you may be given trade payables and other payables. Other payables in other terms, these are also known as accruals. Accruals, or basically accrued expenses. You also consider them here because they are part of payables. But in our case, what are we given? I think we only have trade payables only. And the trade payables also, we have increase. We have increase in trade payables. So how much is the increase in trade payables? Trade payables, how much is the increase? From 7770 to 10200 to 10200. So we have an increase of what? Of 2340. Remember, payables, this is the amount of money which a company owed to the suppliers. A company owed to the suppliers. So the reason why the amount owed to the suppliers increases is because the suppliers did what? Supplier gave the company an additional credit. Gave the company, this company, an additional credit. You see, a supplier can give you credit in various ways. Once you buy some goods on credit from a supplier, in this case, it is assumed that the supplier has given you a credit. Because if the supplier, for example, refused to sell some goods to you on credit, the other option available to you is you go to your bank and you plead with your bank to give you an overdraft. Once they give you an overdraft, now you go back to the supplier, you do what? You purchase or you buy the goods on what? On credit. So that's why an increase in trade payables here, an increase in trade payables here is basically a cash what? A cash inflow. A cash what? inflow. So I think those are the three items we consider here. And then from there, we need to get the net amount. So can you adjust now our figure here with those three items? With those three items, so that's when we come here and we consider tax and finance cost. Yes, what are you getting? What are you getting? I'm given a figure of 12,255. And basically now to that figure, we need to come here and we less two items. We less the tax paid and the interest or finance cost paid, finance cost paid. Now for tax, this one we said there is an account you have to prepare, because in most of the questions you will be given the two components of taxes, the deferred tax and the current tax. We said you have to prepare an account called the tax account for you to determine how much amount of tax was paid by this company, was paid by this company. So let's prepare that account, and I hope you can remember the format which I gave you. That is the format basically which we follow here in preparing that account. The account which is called tax account. Tax account. That account we prepare it to determine how much tax was paid. So this is basically we looked on the format. We said when preparing this account, we go to where we have liabilities. We take into account the deferred tax and current tax at the start, and also at the same at the end of the year, deferred tax and the current tax. And then from the income statement, we take into account the tax for the current financial year, which should be credited there. And then we said we balance our account. A balancing figure on this side is a tax refund. A balancing figure on this side is a tax paid, is the tax paid. So this is a format which I gave you in our previous class. So what we need to do, can we go to where we have to a statement of financial position, specifically at the liabilities, at the non-current liabilities and current liabilities. You'll be able to see something given there. First of all, at the non-current liabilities, we have something called deferred tax. Deferred tax, we said deferred tax is a tax payable by the company in the future. So how much was the deferred tax at the start? The deferred tax at the start of the year is 810. And then the deferred tax at the end of the year, deferred tax at the end of the year is 1920. I hope that is clear. Is the balance carried down. Deferred tax here is 1920. And then under the current liabilities, in our statement of financial position, we have the current tax. We also take into account the current tax. The current tax at the start was 2775, and the current tax at the end of the year is 2685. 2685. Then from there, what we do, we go back to the income statement. From our income statement, how much was the income tax expense for the current financial year? That is something we get from the income statement. From the income statement, can you see the figure for the income tax expense for the current financial year? Yes, I can see that figure as 2655. So then from there, you balance your account. If you get a balancing figure on this side, is a tax refund. If you get a balancing figure on the debit side, is a tax paid, So can we do that? Let's balance that account. So on the credit side, we have 810 plus 2775 plus 2655 minus what we have on the debit side, 1920 minus 2685. So I'm getting a balancing figure. On this side, which is 1635. Are you getting the same? 1635. 1635. Is that what you're getting? Yes. So that is the tax paid. The tax paid is 1635. And basically we said that is a cash outflow. That's why we less it. So then from there, we do the same for interest or finance cost paid. This one is quite simple because here we only consider two items. First of all, you go to where we have current liabilities. When determining the interest or the finance cost paid, under the current liabilities, you check whether there is something called accrued interest. Under the current liabilities, do we have any accrued interest? Any accrued interest? No, we don't have. We don't have any accrued interest. So meaning that the only finance cost or the interest which we have is the interest or the finance cost for the current financial year. And this is the figure we have in the income statement. In the income statement, how much is the finance cost for the current financial year? The finance cost for the current financial year is how much? Is 7 what? Can you see that finance cost from the income statement? Yes, 705. So essentially, assuming, for example, under the current liabilities, we were given accrued interest. We were given accrued interest under the current liabilities. So what does that accrued interest means? For example, we'll be given the accrued interest at the end of the year and at the start. So what this accrued interest means, this is the interest which the company was supposed to pay both at the start and also at the end. So assuming we were given this accrued interest, so how do you determine the interest paid? To determine the interest paid, you come first of all, you take the accrued interest at the start because that is the interest the company was supposed to pay at the start. And then to this, you add the interest for the current financial year because this is the interest the company was supposed to pay during the current financial year. So once you have added the two figures, that will give you the total interest the company was supposed to pay during the current financial year. And then to that deduct the interest not yet paid at the end of the year, which in our case is still 0. And basically that will give you now the actual interest which was paid, because what you have done, we have taken the interest the company was supposed to pay at the start plus the interest the company was supposed to pay during the current financial year. That will give us the total interest payable, then deduct what are not being paid at the end of the year. So the difference should give you the interest which was paid during the current financial year. But in our case, it remained to be what? 705. 7 what? 05. So then from there, finally, we get the net cash flows from operating activities. Operating activities. From operating activities. Yes, so how much is our amount there? I'm given 99.15. 99 what? 15, 99.15. 99.15, someone to confirm whether that figure is correct. 99.15, is that correct? Yes, if it is, so what do we then need to do? What do we then need to do? We need to proceed. We determine the net cash flow from investing activities. From investing what? Activities. So I think we can do away with the first part here. Yes, so we then determine the cash flows, from investing. From investing activities. Investing activities. Now, investing. What should come into your mind here is we are talking of investing by the company. Even as an individual, you invest by acquiring shares. You can invest in real estate, you can buy a plot somewhere, you can invest in terms of buying shares. And that's why we said investing here purely entails, or here you consider the asset which were acquired by the company, the asset which were disposed. So, the asset acquired, the asset which were disposed. And I think from what we have in this particular question, I think maybe from the additional information, number 1, let's go back to the additional information number 1. In the additional information number 1, we know we have the plant which was acquired by the company. Can you remember the plant acquired by the company? We are told the plant acquired by the company as per the working which we did here had a value of 1,800. It was acquired from a finance company, and we were told that that plant was paid for by the company in terms of acquiring loan notes, and therefore he said that that is a non-cash transaction. We will not consider that here because the plant acquired, there was no money which was paid for that, so we don't consider that here. Yes. So this cash which was received from the issue of 10% loan notes, that will be considered, will be taken into account when determine the cash flow from financing, because once the company issue 10% loan notes, the company receives cash. That is basically, that affects the size and composition of the company's capital structure. So what we are supposed to consider here is the plant acquired, but we know it was not paid for in cash. It does not involve cash outflow. Don't consider it here. So number 2, we have the disposal of plant, not the plant, but other motor vehicles. That's what we take into account here. Disposal of motor vehicles. And whenever the company sells assets, so what you take into account here is the sales proceeds. Make sure you write that in full. Sales proceeds, that's what we consider because this is the actual cash received. So the sales or the motor vehicles which are given in note number 2, we are told they were sold for cash of 1,810. 1,810. So this is money received. That's what we consider there, not the cost, not the net book value, but the sales process, the actual money received. 1,810, which is a cash inflow. Being a cash inflow, the rule is that when recording it there, you record it as a positive figure. This is a cash inflow. That, remember, you have to remember that golden rule, which we discussed. Any amount which is a cash inflow, record it here as a positive. Any cash amount which is a cash outflow, record it as what? As a negative. Because by the end of the day, you want to know the net cash received from investing activities. So then from here, what we have in note number 3 is about depreciation. It will not affect that. And then number 4, we have intangible asset. You have to remember we prepared an account here, intangible asset, and we said, other than this amortization, there was some intangible assets which were acquired. So that those intangible assets acquired, acquisition of intangible assets, acquisition of intangible assets which had a value of which have a value of 1140. Once the company acquire assets that involve cash outflow. That involve cash outflow. So we record that figure there as a negative. As a negative is a cash outflow. So that's what we have. And then note number 5 is all about what? About the bonus issue. So the other items maybe which we need to consider here, or ordinarily what you then need to do is you go back to your balance sheet, to your statement of financial position, specifically where we have non-current asset, and you check, have you dealt with the non-current asset which are given there? So like in our case, we have PPE. PPE, I think what we have only considered is the disposal. But we said mostly for PP, you have to prepare an account called the PP account. You determine whether there was some other item, or basically there are some items of PP which were acquired during the current financial year, because we said in most of the cases there will be some PP which were acquired, but the examiner will not give you that. It's upon you to prepare the PP account to determine, well, there are some PP which were acquired. So I think we only have PP because you have dealt with the intangible asset and the non-current asset. Under the non-current asset, we only have a PP because you have dealt with intangible asset. So, and before we prepare the PP account, the other item which you also take into account here is any investment income. Any investment income, or the investment income can also be referred to as interest received. Interest received, of which in our case, we don't have such investment or interest what received. So let's prepare now the PP account to determine were there some items of PP which were acquired during the current financial year other than this plant, So how do we prepare this account? I equally gave you the format for this account. Take into account is an asset account. Always the opening balance should be a debit balance. So the PP, we get the opening balance from our balance sheet. The PP at the start had a value of 27,450. And then the PP at the end of the year, the value is 36,30. And then we said when preparing these accounts, the number of items which we consider here, the number of items which we definitely consider here, So one, we said that a revaluation gain should be debited here. What we credit in our account is the depreciation. I hope you can remember we have depreciation and disposals and any revaluation loss. But we said once you're given a gain, automatically there cannot be a loss. So first of all, in the income statement, the last item in the income statement, we have a gain on property revaluation. A gain on property revaluation. I hope you can see that. So mean that there are some items of PP which were revalued upward, and they were revalued upward with an amount of 2550. So gain on property revaluation, that is part of the income statement. But equally, even if you are not given that item, gain on property revaluation in the income statement, what you do, you go to your statement of financial position, specifically under the equity section, and you check whether you have an item of reserve called revaluation reserve. Whether we have an item called revaluation reserve. Now, if you go to the income statement, the statement of financial position, specifically the equity, we have an item called revaluation reserve there. And I hope you can see that the revaluation reserve at the start was 0, at the end it was 2550. So mean that the revaluation reserve increased with 2550. So the reason why revaluation reserve will increase is because there were some items of PP which were revalued upward. And that's what we take into account there as a gain. But that one is already given in the income statement. Then what we also need to take into account here is the depreciation which we have in the additional information number 3, 5490, the depreciation on PP in note number 3, 5490. And then we also need to take into account items of PP which were disposed during the current year. So, and we have some items of PP which were disposed. You have to remember PP comprises of all tangible and current assets like plant, like motor vehicles, and so on. All of them are part of PP. Yes, so in the additional information number 2, we know we have the motor vehicles which were disposed. So motor vehicles are a part of the PP, and those motor vehicles which were disposed, they had a net book value which we computed here of 1465. So that 1465 automatically reduces the PP which was there at the start of the year. Reduces the PP which was there at the start of the year. Yes, I think that's what we have. We have in the additional information. We also have to remember to take into account this plant which was acquired. The plant which was acquired, which had a value of 1800, but basically we know that this plant was not paid for in cash. So then from there, what we do, we balance that account. So, and the balancing figure here will automatically represent the PP, if any, which were acquired in cash. And that now will be the balancing figure on this side. So can we do that? So we have on the credit, we have 5490 plus 1465 plus 36300 minus now what we have on the debit, 27,450 minus 2550 minus 1800. Minus 1800, I'm getting a figure here of 11,455. 11,455. Are you getting the same figure? Are you getting the same? Are you getting the same figure? You getting the same figure? You need to confirm whether you're getting the same. Yes, I'm told you're getting the same. So this 11,455, this represents the PPE which were acquired by the company in cash. In cash, remember you have said this plant, and that's why we are recording it separately, though it is a plant which was acquired, but we know it was not paid for in cash. That's why we are separating that from the other items of PP which were acquired in what? In cash. So those PP which were acquired in cash, we take them into account here. And basically we know that once the company acquired PP, that involves cash outflow. Do we have anything else here we need to consider? We need to consider? No. So automatically we don't have anything else we need to consider. And actually this should be in the first column of your cash flow. Sorry for this, it should be in the first column of your cash flow, not in the last column, such that the net amount is what we record in the last column. Remember, you should have two columns. So how much is the net amount here? So we have 1810 minus 1140 minus 11,455. So I'm getting a net cash outflow of 10,785. And then finally, we determine the cash flow from financing activities. The cash flow from financing what activities? Cash flow from financing activities. I hope you're getting that figure. Someone can confirm. Kennedy, are you getting the same? Okay, so let's finally we determine this, the cash flow from financing. Now, cash flow from financing we said are those activities which affect the size and composition of the company's capital structure. Now, what is important for you to remember here is that all the items which we include here, or which we take into account in determining the cash flow from financing activities, all items, we get them from equity plus non-current liabilities section of the statement of financial position. Of the statement of financial what? Position. Statement of financial position. Statement of financial position. So, Kennedy, is that figure correct? No, it can't be 85. Can't be 85. So, can someone confirm? Guys, you need to confirm this figure. Yes, I'm told it is correct. It is correct. Okay, so let's do this. So I've said all the items. Then you want to record up. All of them we get from equity and current. So therefore, here what you do, you go to what? To your statement of financial position, specifically equity and current liabilities. You do what? You get the items to be included here. Now, who is saying can't be able to see? One, is my internet still having issues? And can't see the others complaining. Yes. Oh, Morimu's internet is very, very, very perfect. It's good today. It's not misbehaving. I can be able to see that. Yes. So the internet today is very okay. Yes. So let's determine this. And basically I've said HAPA, you just go to where we have the statement of financial position specifically at the equity and non-current liabilities. That's why you get all the items to be included here. So it's very, very simple. So can we go to, first of all, where we have the equity section? So under the equity section, we have the ordinary share capital. You can remember there is a working we did as far as the ordinary share capital is concerned. And we said the ordinary share capital of the company increased with 15. So that increase is due to the bonus issue, which we said this one will not be considered here because no money which was received in relation to the bonus issue. What we consider here as far as the issue of shares is concerned is the figure of 900. So issue of ordinary shares. Issue of ordinary shares. How much is that? Is 900. So don't consider the bonus issue because no money which was received as far as the bonus issue is concerned. So you only consider now the other shares, which had a value of 900. Then below that, what do we have? We have a share premium. Share premium at the start, 1050, at the end, 1350. So we have an increase in share premium. Okay, before we do that, I think this will also be affected by bonus issue. Can you go to the additional information number 5? Number 5, what are we told in number 5? We are told during the year the company made a bonus issue of 1 share for every 10 shares which were held, and basically this was financed by the share premium. So that automatically we need to prepare that account. We need to prepare that account which is called the share premium. I'll be able to tell you why we need to prepare that account, share premium. So share premium, we know that this is a reserve account, and being a reserve account, it automatically means that this account should have a credit opening balance. So what was the share premium at the start of the year? The share premium at the start of the year here was 1050. That is the share premium at the start. And then the share premium at the end of the year was what? Was 1350. Now, how do we account for a bonus issue which is financed by a share premium? So once the company make a bonus issue and the company finances that bonus issue using the share premium, we have said the implication of that is that the share capital of the company increases. So we increase the ordinary share capital, then we reduce the share premium. So mean that the share premium which was there at the start of the year will have to reduce because the company did what? Issued or basically made a bonus issue and financed that from using the share premium. So therefore, a bonus issue should be debited in this account. The bonus issue debited in that account should be 600, and the corresponding entry should be to credit the ordinary share capital, because this bonus issue should reduce what? The share premium. Alternatively, if you have a challenge with that account, I hope you can remember how we were preparing the statement of changes in equity. Statement of changes in equity. So, for instance, here, if you are to prepare the statement of changes in equity, you take the ordinary share capital to the start, which is 1050. You come and you say, because the company made a bonus issue, that bonus issue, the shares issued, or the bonus issue which was made, you less it from that because it reduces the share premium. And then you'll see that the balance carried down is 1350. That is the balance carried down, the share premium at the end. So if you take this minus that, you'll see it will not give you 1350. It will not give you 1350. So what do we have? 1050 minus 600. So that should give us 450. But how much is the closing balance? The closing balance is 1350. So we have a difference of 900. So in basically automatically this is increase. This is increase. So the reason or the other item, or basically what makes the share premium to increase, is because there were some other shares which were issued by the company during the current financial year, and those shares were issued at a premium. So therefore, this increase, which now will be on this side of 900, this represents, or this increase is due to the issue of shares. The issue of what? Of shares. You see these shares here, which were issued by the company for cash, automatically was also issued at a premium. And a share premium also represents the money received by the company. Once the company issues the shares at a premium, the shares are issued at an amount which is above the par value. So therefore, we also take into account that increase here in share premium. The increase in share premium of 900, it also represents the money which was received, but in form of share premium, share premium. And I hope you know what is why the share premium arises. The share premium arises because the company issued shares at a price which is above the par value. The par value is the amount which we have in the statement of financial position, and also those who are doing company law, this is something you cover in company law, that whenever the company is to issue shares may be issued at par value, or shares may be issued at a premium. So once the shares are issued at a premium, they are issued at a price which is above the par, the nominal, or the face value. And the requirement of the law is that once the company has issued the shares at a share premium, an amount equal to the share premium must be transferred to an account called the share premium account. So the reason why that is the case is for the share capital of the company to be maintained. So this is something you cover in company law. Once you register a company with a share capital of 100,000, the share capital of the company should not exceed 100,000. So if you happen to issue shares at a premium, an amount equal to the share premium, you transfer it to an account called what? The share premium. I hope this is something you cover in in company law. Sasa, yes, basically that's therefore what we consider here as far as the share premium is concerned. Let's go back to our statement of financial position. We need to finish on this. So below the share premium, what we have is the revaluation reserve. The revaluation reserve, you can see at the start of the year was 0. At the end of the year, it was 2550. So the reason why that share revaluation reserve increased from 0 to 2550, I hope you can remember this revaluation gain. And basically, revaluation gain is a non-cash item. So we don't consider that here. So once the company revalue assets upward, so that do not give rise to cash inflow. So we don't consider revaluation reserve here. The other item below there is the retained earnings. Now this retained earnings figure, we use it in terms of computing the dividend paid. Are we together? Yes, we use the retained earnings figure to compute the dividends paid. So how do we compute the dividends paid? How do we compute the dividends paid? Very, very simple. So what we do, I'll give you the general formula here. We take the retained earnings at the start. To this, we add the company's profit after tax, and then we less the retained earnings at the end of the year. That's how we compute the dividends which were paid. The retained earnings at the start plus profit after tax minus the retained earnings at the end. Are we together? Yes. So can we do that? So how much was the retained earnings at the start? 980. So to this we add the profit after tax. The profit after tax, this one we get it from the income statement. We get it from the income statement. The profit after tax is the same with the profit for the year. Can you see that figure? It is 55.35. That is the profit after tax or the profit for the year. And then to this, we less the retained earnings at the end. The retained earnings at the end is 28,065. So the difference automatically will give us the dividends proposed and paid, or basically the dividends which were paid. Can you give me that figure there? And that is the general formula now which you'll be using throughout in terms of computing the dividends which were paid. You compute the dividends paid using the retained earnings figure. Yes, so that will give us how much? Dividends paid of how much? 25,980 plus 535 minus 26,065. 28,065. Yes, I'm getting dividends of 34. 50. So basically, we know that the dividends paid involve cash outflow. So record that figure there as a negative because it involves cash outflow. So then from there, what do we have? Retained earning. Okay, we have dealt with the retained earnings. So basically, you can see we are through with all items of equity. I hope you can see that. We are through with all items of equity. Then from there, what we need to do, we go to the non-current liability section. And the non-current liability, I think there we are only considering okay, two items. The 10% loan note and the government grant. Remember, you have already dealt with the deferred tax in computing the tax paid. So we are not considering the deferred tax here. Also, there is some working we had done as far as the 10% loan notes are concerned. I hope you can remember this working one. And we said what we are considering here, what we need to consider here, and the 10% loan notes which were issued by the company for cash. So the increase in the 10% loan note is 3,000, but we know that part of these loan notes were issued to pay for the plant acquired. And what we consider here is the amount now which was received from the issue of 10% loan. So issue of 10% loan notes. So basically, you're not considering the entire amount of 3,000, but you're considering the amount which was received from the issue of the 10% loan notes, which is how much? 1,200. 1,200, because the other loan notes, which had a value of 1,800, they were issued by the company to pay for the plant which was acquired. So no cash was received as far as the loan notes of 1,800 are concerned. That's what we said. So the other item we need to consider here is a government grant. Government grant, we have to prepare that account. We have to prepare that account here. I think now we can do away with this. So let's prepare that account, and equally I give you the format for preparing the account, which is called the government grant. The government grant. So government grant account. Government grant account. So the reason why we need to prepare this account is to determine, was there any government grant which was received during the current financial year? Because from the income statement, I hope you can remember, we were given the amount of government grant which was amortized, which was recognized as an income during the current financial year. So the government grant is basically a liability. So we first of all take into account the opening balance, which should be on the credit side, and the government grant, part of the government grant is classified as non-current liability. Part of it is current liability, and also at the same at the end of the year, we take the government grant under the non-current liabilities and also under the current liabilities. So can we do that? The government grant, which is part of the non-current liabilities, is how much at the start? Part of the non-current liabilities at the start is 24. At the end is that 150. Then we also have government grant at the non-current, at the current liabilities. At the start 600. At the end 810. I hope you can see those figures. Government grant at the non-current liabilities and also at the current. So the other item which you also take into account here is the government grant which we have in the income statement. The government grant in the income statement, and that amount in the income statement, we said is basically the government grant which was amortized. How much is that figure? And which we said should be debited in this account. Remember, I gave you the format for preparing this account. Is how much? Is 750. Then the balancing figure on this side, represent the government grant which was received during the current financial year. The government grant received during the current financial year, and that's what we consider here. So can we check whether there was any government grant which the company was received during the current financial year? So on the debit side, we have 750 plus 150 plus 810 minus now what we have on the credit, 2,400 minus 600. And I'm getting a balancing figure here of 1710. Can you confirm whether you're getting the same? So basically that amount here is the government grant which was received. Government grant, are you getting the same figures here? Of 1710. Yes, so that represents the government grant which was received by the company during the current financial year, and automatically that is cash inflow. That is cash what? Inflow. That is cash inflow. Do we have anything else there we need to consider? And non-current liabilities? No. We have considered the 10% loan notes, the government grant, deferred tax. We are not considering that here because we use that in terms of computing what? The tax paid. I hope you can see where we have gotten all the items which have included here at the equity and what? Non-current liabilities section. So finally, we can get the net amount so that we finish. So the net amount here will be what? We have 900 plus 900 minus 3450 plus 1200 plus 1710. So that will give us 1260, which is a positive figure, 1260. So then from there, we need to add three figures. We need to add the net cash flow from operating activities, net cash flow from investing activities, net cash flow from financing activities. Whatever we get is known as the net, and the net changes in cash and cash equivalent. Make sure you write that in full. The net changes in cash and cash equivalent. Net changes in cash and cash equivalent. So when I'm given a figure, a net amount of 390, whatever is a positive when adding, whatever is a positive, you take it as a positive, whatever is a negative, you take it as a negative. So just confirm whether you're getting that figure there. Are you getting 390 after adding those three figures? Net cash flow from operating activities, net cash flow from investing, and net cash flow from financing. Are you getting 390? Okay, yes. So after getting that figure, which we refer to the net changes in cash and cash equivalent, to this we proceed and we add cash and cash equivalent balance brought down. Remember I said when we are talking of cash here you consider a number of items: cash in hand, cash at bank, and the bank overdraft. In the event you have all those items, you have to add them. And cash equivalent. Cash equivalent, we said, are short-term investment. These are investments which are classified as part of the current asset. So what do we have in our question here? What do we have in our question here? Basically, we get those items at the current asset and the current liabilities. At the current asset, in fact, we're given the cash and cash equivalents as a total figure because we don't have cash in hand, we don't have cash at bank, we don't have short-term investment, and equally at the current liabilities, we don't have bank overdraft. So the cash and cash equivalent at the start of the year is 510. So after adding the two, what we need to do, or basically what we get is the cash and cash equivalent balance carried down. So that will give us a figure of what? This should give us a figure of, is it 900? 900. Should give us 900. And basically, whatever you get here is the cash and cash equivalent at the end of the year should always be the same with the cash and cash equivalent from your statement of financial position. From a statement of financial position, is our cash and cash equivalent at the end of the year 900? Is it 900? Yes or no? Is it 900? Yes, it is 900. Automatically, those two figures should reconcile. They should be what? They should be the same. And once they reconcile, it automatically means that you are 100% what? Correct. 100% correct. Yes, so that is it. That basically what was required as far as that particular question is concerned. It was a good question on the statement of what? Of cash flow. Is a good question on the statement of what? Of cash flow. So I think for now, we stop at that particular point. And then what you'll do, make sure you attempt another question for August, the same year, August of 2022. Once we meet on Thursday, what we will do, that is Thursday is tomorrow. Yeah? Yes, Thursday is tomorrow. So we will do that question for August of 2022. So that now we wind up with that particular topic for cash flow. And then from there we proceed to something else. So therefore for today, unless maybe there is a question, or for now, unless there is a question, I want us to stop at that point. Any question? Do we have any question? I think there is none. So therefore, let's stop at that point. Have a nice holiday. See you tomorrow.